Hello traders and investors, Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, the S&P was slightly muted, but the Qs saw little gains. However, technology stocks, for the most part, continued to drop. The QQQs today were mostly upheld by big names such as Apple, a lot of the semiconductor names, and even Tesla showing up to play. However, the SaaS-pocalypse, the disaster continues. So many software names, once again today, getting the short end of the stick, and even some of the larger cap ones like Microsoft, Oracle, Palantir down, Google down about 2.29, and Amazon down as well. So the tech landscape remains very mixed. Software names continue to be wildly out of favor, but the hardware names and infrastructure players continue to be very much in favor, and the bottom half of the market continues to shine through. So a very bipolar, bifurcated market where some names are being rewarded, but some other names are just being left for dead. So in today's video, we're going to recap all of it for you, of course. Speaking about today's video, we're going to do a few key things. Number one, we're going to go over 3 earnings reports that we have prepared for you guys today. Number 1 is going to be Shopify. Number 2 is going to be AppLovin. And number 3 is going to be Vertiv. So we'll take a look at those and see how their earnings went and whether or not these companies are good buys at current levels. Thereafter, guys, we'll get into our classic technical analysis rundown of our major stock market indices, check on those. Thereafter, we will take a look at our big tech names all the way down here because we know many tech names have been underperforming the markets as of recently. So are they still good buys, and when can they possibly turn around, and at which prices? We'll take a look at that. And at the very end of the video, we will take a look at our biggest gainers and losers of the day, something we didn't have time to do yesterday. So today I'll try to get through the earnings reports a little bit faster. That way we have more chart time to go through not only the indexes, but also the big tech names we usually cover. And then it's additionally some of the names here that continue to be unfavorable. Are there some good deals in the market right now? Well, yes, there are. There are some names here that I wouldn't be buying, but some names that I would definitely be buying at current prices. So we will recap those towards the end of the video. And that should be it for today. So it should be a very fun one, as per usual. Let's get right into it, shall we? The S&P on the day, flat, the Qs up 0.27, and as we already showed the heat map, somewhat of a very mixed market, kind of the same thing that we've been seeing over the course of the past month, right? Very awkward price action here in some of the big tech names. As you can see, NVIDIA had a good day, Apple did too, and Tesla did as well, but Microsoft down another 2%, Amazon down 1.4%, and Google down 2.29%. A lot of these companies just can't shake the unfavorable price action that they've been having since their earnings, sadly. Software continues to be a big pain point for the day. The banks as well were down quite significantly today. JP Morgan, Bank of America, and others down 2-3%. The credit card company is not too bad. So financials, very mixed. It was a down sector on the day. Healthcare coming to play today. Very nice day there. And the bottom half of the market continues to be the outperforming segment, right? Consumer staples and energy have really had a beautiful start to 2026 so far. Those indexes are up, substantially. If you take a look at just the XLE right here on a year-to-date basis, this one's up 23% year-to-date. And you might remember me highlighting how good of a trade it might be down there. So hopefully some of you guys were able to get into that trade. And even consumer staples coming into the early part of the year, we were saying watch the rotation into value, dividend plays, and staples, and that sector too, that one's up 14% almost on a year-to-date basis. And that's quite significant outperformance against your traditional QQQ benchmark, right? Qs are actually down 1.12% on a year-to-date basis. So the rotation in the markets does continue. However, not favoring tech names whatsoever, so please keep that in mind. On the one-day relative, you can see that even better. Once again, energy, materials, defensives, and utilities posting some of the biggest gains for the market. Industrials, healthcare, shout out to them as well. Technology, largely mixed, as there were some very nice gainers, but some big losers as well. To the downside, financials, communication services, real estate, and cyclicals. On your 1-week relative performance, guys, the market remains fairly balanced, although sometimes our favorite names that we talk about a lot on the channel, some of the big tech names, some of the other tech names in our lists, right? Although they haven't been performing too well, you can't say that the market hasn't been doing well overall. A lot of the market segments are indeed higher, and even technology is. It's not all of technology, but broadly speaking, technology has had a pretty good last week of trade since the bottoms that we saw just last week. The only 3 sectors that remain in the red on a 1-week relative performance basis are financials, cyclicals, and communication services. And I'll remind you, communication services is largely Google, Meta, and Netflix would be your 3rd largest position there too. So please keep that in mind. Now, Fear and Greed Index currently still sits at a neutral ranking right now, as you do have a overall lack of momentum in the market. And this Fear and Greed Index does not necessarily measure investor sentiment. No, it's just a bunch of momentum cues, right? How far are we away from our 125-day moving average in terms of stock price strength, in terms of net new highs and lows on the New York Stock Exchange? You can see it's quite good. There are many more names hitting all-time highs then vice versa, right? So that's very good. Stock price breadth as well remains fairly strong, but overall market remains in a bit of a neutral condition right now. Market breadth is very, very solid, guys. I mean, we bring this up almost every single video. Percentage of stocks above their 20-day EMA, that's still okay at about 53%. Percentage of stocks above their 50-day EMA, which is the institutional metric that they watch a lot. 58% of all stocks are above that. And percentage of stocks above their 200-day EMA, 62% of the entire market is above their 200-day EMA. So keep that in mind, right? The market breadth is just fine. It's just certain pockets of the market have been deeply, deeply out of favor. And as a matter of fact, if we take a look here, I should have had this one up already, my bad, but I keep bringing this one up, right? If you take a look at the names that have been performing well this year, a bunch of memory companies on the tops right here, SanDisk, Teradyne, another interesting company, Western Digital, Generac, right? That provides generators, a lot of them for commercial applications in line with the data centers, Corning as well, fiber optics and glass, that's been really good. So you can see a lot of the stuff that goes inside the data centers have been doing very well. Some of the hyperscalers paying for the data centers, such as names in the Mag 7, they haven't been doing well, but a lot of the things associated with the data center trade have been doing really well. Texas Pacific Land Corporation as well, a lot of land in the Permian Basin, done very well. Micron, Fixed Comfort Systems as well, which is basically just well, they do a lot of things, but namely a construction company for a lot of the data centers as well. So it is a lot of data center names here that are outperforming the markets on a year-to-date basis. Caterpillar as well, because of their diesel generators in line with the data center applications as well. Of course, they do heavy machinery, but the fastest growing segment for them has been those massive diesel generators overall. So please keep that in mind. And then you got some of the legacy semiconductor names, right? We talked about memory, but Applied Materials, a lot of the, equipment manufacturers for semiconductors have been doing very well, but the defense trade too, like the defense trades have been doing really well so far. Lockheed Martin, some of the larger ones out there, such as Northrop Grumman and RTX have been performing quite well this year. But then you have a bunch of companies down here that are more like value-oriented companies, right? So you got a couple of the miners like Freeport-McMoRan for copper, things of that nature. Then you got names like FedEx up here, right? FedEx, Hershey's Corporation, things like that, GE Vernova, something else for the data centers. But if you take a look down here, a bunch of oil companies, Clorox is up 25% year to date, right? Honeywell, also defense, Analog Devices, Semiconductors, Eaton Corporation, power, right? So utilities, industrials, power, semiconductors, everything that goes inside the data centers. But you can also see so many value stocks, right, that are moving really well. Like UPS, which has had 4 terrible years in a row. They're already up 21%. Iron Mountain, Colgate Palmolive up 20% right now. Verizon, of all companies, up 20% year to date. So very bifurcated market here. And then if we go all the way down to the opposite end, by the way, out of 500 something companies, 340 are posting in the green so far this year. So, many more names are indeed green than red over the course of the so far month and a half that we started the year. But then look at the names down here, guys. I mean, Intuit, it's down 40% year to date, right? Gartner, 35, ServiceNow, 34, FactSet, 33, Workday, Coinbase crypto. So crypto and software, man. Robinhood, PayPal, Salesforce down 30%. Molina Healthcare, some of the health insurers not doing too well. Trade Desk down another 28%. Fidelity Information Services, Adobe down 26%. Even S&P Global, which we talked about just the other day, 25%. Palantir, 23%, right? Look at all these software names getting absolutely destroyed. And even companies that, they are software companies, but that's just because that's what they use for their products. They're not pure play SaaS. Like Booking.com, down 19%. Super high quality names right there. FICO, Moody's Corporation, Expedia down 17%. So much destruction. Microsoft down 16% year to date. So much destruction in some of the tech names overall. especially those more in line with the software play and even like indirect software overall, which is why sometimes it's very confusing. And we've been talking about that, of course, almost every single day over the course of the past 2-3 weeks at this point. So please keep that in mind. In terms of other things, before we get into our earnings presentations, guys, there was one big piece of news that came out today, and it was indeed the jobs report. We were paying attention to this one because it was one of the bigger catalysts for the week. Non-farm payrolls coming out at 130K versus the 70K expected. That was a very good report. Average hourly earnings 3.7 versus 3.6 expected, so far outpacing the current rate of inflation, and that's what you want to see when you're looking for consumers to progressively regain their purchasing power. The unemployment rate down a little bit of a downtick from the 4.4 expected. They posted a 4.3, which is not too bad. So we only have one other thing to look forward to coming on the Friday session, which will be CPI. The expectation is for 2.5 versus last month's read of 2.7. And we know I keep bringing up the Truflation gauge, but just so you guys understand, Truflation measures 15 plus million products and services on a daily basis, currently sitting at 0.74. So there's a big discrepancy here between the BLS reported rate of 2.7 and this Truflation index, which is a lot more broad and a lot more up to date as well. So please keep that in mind. Inflation's not a problem, but you will have to pay attention to the jobs market. Here's what the jobs market looks like at a glance. You can see that yes, the economy is creating less jobs overall than previously in 2022, 2023, and 2024. Those are the dashed lines that give your averages in terms of monthly gains. Now we're kind of still in a no hiring, no firing environment. We heard from the Fed. Jerome Powell told us as much a few weeks ago. And he did also say that the visibility into the jobs market was now better than just a few months ago as such, but still there are some concerns, and they're very warranted because it's a no hiring, no firing economy. So which way is it going to shift? Are companies going to start hiring again, or are companies going to start firing more? And this is exactly what the article highlights right here. The low hire, low fire environment continues for now, and the declining unemployment rate is always a welcome sign. But this balance is precarious. The Federal Reserve has been waiting for a while now for some kind of clarity in the market to help inform the future path of key interest rates. And this data won't help one way or another. At some point, either the hiring rate will increase and payroll employment reports will improve, or the flame will be turned up on the low fire dynamic and unemployment rates will begin to increase. So we're still looking at this on a month-over-month basis. Obviously, the jobs market is not an extremely healthy, massive hiring spree right now, but you can't also say that the numbers are falling off a cliff in terms of posting negative job numbers month after month after month, and corporations firing people by the millions essentially because they're worried about the economy. No, companies are indeed getting leaner, but it's not because they have to necessarily protect profits in fear of an economic downturn. Some companies had execution problems, and as such, they laid off a bunch of employees, such as Verizon, such as UPS. Some other companies are seeing tremendous efficiency gains from robotics and AI, and you don't have to look further than companies like Microsoft or Meta or even Amazon, so to speak, right? So very strange jobs market right now, but we'll have to keep this one on the watch for the next few months as we get more and more reports. So that being said, that's your market introduction, a little bit of a check on the indexes, the rotation, a little bit of information on the software companies and the labor market. Hopefully you guys enjoyed. Now, before we get into more technicals, let us go over the earnings reports. And I promise I'll try my best to keep these as brief as possible. Company number one we're going to be taking a look at here, guys, is going to be Shopify. Now, what a swing on Shopify today. Initially, after the report, the company was up 13%. And then when the markets open, I mean, just because it's a software company, and I guess Claude will be able to just vibe code away this entire business in the future, right? 24% top to bottom swing before the stock ended the day down about 6.7%. It was a very nasty swing, and arguably they did not deserve that, but such has been the nature of the market recently. After many earnings reports, companies can report very good numbers, very good guidance, but still at the open, a lot of volume pulls in, right? And you just get flushed completely at the open on some of these names in spite of them being up in the pre-market, and then they kind of normalize, right? So that being said, at $118 right now, is Shopify a good buy? Is the business still doing well despite it being down from recent highs approximately from 180 down to where we are right now? 35%, is it a good pickup? Well, let's have a look at some of the numbers, shall we? So in terms of the EPS, they did miss on EPS by about 6%. They beat on revenue by about 0.96%, but the benefit of these earnings was the guidance. So you could justify a little bit of a drop because of the EPS miss, but the guidance was so good, guys. It was so good that that's why it did pop in the pre-market. So keep that in mind. Now, in terms of some of the easy numbers for Shopify, you'll see right here that they did beat on their total revenue estimate as we determined, right? However, it's the year-over-year numbers that were really staggering. Still 31% growth on total revenues, 17% subscriptions, and 35% growth year-over-year on merchant solutions. Gross merchandise volume increased 31%, which was very solid. Monthly recurring revenues up 15%. All of those were beats. They beat on operating income as well by about 11%, which is good. They're improving their operating efficiency and operating margins as well. As you can see right here, an improvement of 1.5% versus the estimate. Operating margins now 20.7%. And overall, guys, just maintaining on par with what they had last week. The only negative event, as we said, was EPS, but that was still an increase on a year-over-year basis. And EPS will be doing a lot better for them into the second part of the year in 2026 and also moving forward. I mean, Shopify does not have an EPS growth problem. If anything, they're growing EPS extremely rapidly, which we'll touch later upon on the video. 32% on average for the next 3 years through 2028. Look at this EPS expansion curve. Beautiful expansion right there. And the revenue expansion curve, beautiful expansion too. So that being said, guys, they also gave guidance. The guidance was very strong, a 4% beat on guidance for Q1 and year over year. I don't know if my head's in the way. No, I don't think it is. So what's in the way of that one? Let me just move it over so you can see, right? 4% surprise on Q1 revenue guidance. And then that would give you a 31% year over year revenue increase at the end of Q1. So very solid numbers by Shopify. If you take a look here at their total revenue breakdown, you can see just how massive the revenue acceleration is becoming right now on total revenues. But look at the merchant solutions. Merchant solutions is just really, really, really strong right there. And even subscription solutions revenue, we'll break down those components when we go through their earnings slides. But just to let you guys know, Shopify is really firing on all cylinders right now. Moving on into some of the key highlights of the business right now, when we're talking about the growth of GMV, look at this, guys. Massive GMV increase in 2025, 29%. So they're re-accelerating from 2022 to right now, almost every single year. Well, not almost every single year indeed. Merchant solutions, subscription solutions also performing very well overall. Take a look here. Shopify payments penetration continues to increase over time. 66% of people who are using the Shopify platform also choose to use their payment rails, right? And that was a big integration that the company included, you know, about 5, 6, 7 years ago at this point. And they're doing very well. As you can see, every single year, without exception, more people choose to use Shopify payments as their backend instead of other players such as Stripe or other integrations. Shopify offers integrations for almost everybody, but the fact that people choose to use Shopify's in-house payment platform is very, very good. Obviously, very accretive for the margins of the business overall. Monthly recurring revenue continues to grow at a 20% 5-year compound annual growth rate. Very solid. And we're going to kind of break this stuff down in terms of what they do. Just give me a moment here. Gross profit, you can see a slight little decline right there, but still year-over-year comparables, 24%. So still very, very good, right? They are protecting their margins for the most part. Free cash flow, 17% growth year-over-year. That was also very solid, up to $2 billion for the full year so far. Quarterly breakdowns, look at this big GMV number. Q4 is usually Shopify's best quarter, and you can see not only are they comping very strong, but just this GMV number is quite staggering. Revenue, you had a nice upswing here in merchant solutions and subscription solutions overall, so please keep that in mind. Shopify payment penetrations continue to drive higher over higher just numbers in terms of gross payment volume. $84 billion goes through their payment network every day. So here are some of your breakdowns, right, in terms of your subscription solutions. Subscription solutions, guys, 17% year over year, very solid. Now, you do have some, Shopify has different plans, right? Depending if you're a small business or you're a big enterprise, you can choose different tiers of plans. So that's their standard revenue. Shopify Plus is just in a little augmented version of that, as we said, moving through the different tiers. But they also have, in terms of their apps, themes, domains, and variable platform fees. So you can integrate a whole bunch of things on your Shopify website, such as different add to cart features, different themes for what you want your website to look for, different app integrations into your web page overall, and Shopify does charge for every single one of those tools that you choose to include, just to show that all of these segments are performing really, really well overall, right? There is a little bit of choppiness here and there, but nothing that really screams any red flags across the board. Now, in terms of the gross profit, as we said, gross profit as a percentage was coming down a little bit, but in terms of absolute numbers, it is very, very strong overall in terms of the year-over-year growth rate. This is one of my favorite slides for the business right here, delivering continued operating leverage. Total expenses as a percentage of revenue is coming down. So very nice operating leverage right here, guys. As they continue to scale their revenues, operating margins continue to climb higher, or you can say on the flip side, right? Operating expenses become a lower and lower portion of their overall revenue. So very solid stuff here, guys. You know, whether it's different sales profiles from their operating expenses, sales and marketing, R&D, G&A, et cetera, et cetera, et cetera, continue to be a little bit trimmed in terms of that. And free cash flow margins, guys. Free cash flow business is very strong right now, overall delivering more and more every single quarter. So very strong quarter by Shopify overall. And, you know, if you don't know, Shopify is a business where they cater to just so many styles of clients overall. They have so much integration too, right? Whether it's for payments or marketing or multi-channel marketing as well, multi-channel integration into the websites too. Everything is within them. They also offer several AI solutions as well. So they are part of the AI trade. They've been making a very big push in everything like that. And they just offer everything too, right? Like cross-border services, back office services in terms of Shopify tax, et cetera, et cetera, et cetera. Now, just want to show you some of the brands that are part of the Shopify networks, because it's not only small and medium mom and pop shops, essentially, right? Or individual entrepreneurs. No, many very large brands choose to use Shopify, both for the checkout experience with the payment network, but also just for the ease of use of the website layout and all of the various integrations, right? And you can see names like Gymshark, Reebok, you know, Herschel, Kith as well is up there. Some of the Nike strength divisions are on there as well. Molson Coors, Mr. Beast, Mattel is there too. Kraft Heinz, Dollar Shave Club. You know, so many things. Fashion Nova. So many different names overall. And the Q4 brands that they added, Colors of Benetton, Sonos, Keurig, Dr. Pepper, GM, a big one, L'Oreal too. So many more than this, right? In terms of just very, very large businesses that use this. So they have everything from the small and medium businesses to the very large corporations, which makes them a very well-rounded business overall, that being said. So, you know, Shopify, it was a very good report. They beat on many things. What I love to see the most is the fact that they just continue to improve their leverage, right? Their operating leverage in terms of their margins. So gross margins, you'll see right here, they've come down from the low 50s to the high 40s, like 51 down to 48, but that's not such a big deal, right? What you got to focus on truly is the clear improvements in their operating margins over time. Very good. Their net margins have always been a little bit choppy, but they did deliver a very solid quarter of net margins just recently here, 20.2%. So it raises the question, guys, after such a big sell-off on Shopify, coming nicely down into our previous support structure, our previous resistance structure here, now a support into some of the long-time monthly moving averages, down 35% from the high. Is Shopify a buy down here at about 118 bucks? Well, in terms of the valuation, guys, at 115, it's trading for a 61 forward price to earnings, which may seem high, but don't forget they are growing at 32% EPS on average for the next 3 years, which gives them a PEG ratio of 1.93, which is also slightly high, and their price to sales is also 10.6, which is also a bit high. However, you got to keep in mind, guys, that Shopify gets a bit of a higher valuation because it's kind of like a unicorn company, and there's not so many companies in the market that you can clearly look at them and say, nobody else really does this. I mean, they are the de facto leader in just personalized e-commerce. Right? We're not talking about wholesale e-commerce like Amazon, because Amazon's the king of that, but no, just personalized brand e-commerce. They are the absolute king of the market. Nobody is kind of there as a second or third player doing this. They are one and alone in this. And since they have such high growth rates, the market has given them a good valuation overall. Now, you're not buying it at some of the lows of 2022 and 2023, but I'd be hard pressed to believe that the stock may revisit those numbers as they've improved their metrics so much since those 2022 lows. I mean, what was EPS back in 2022? It was nothing. 2023 as well, it was nothing. Now this year, almost $2, and moving forward, EPS will continue to move higher. Revenue, same concept, right? Back in 2022, 2023, they're making $7 billion. Now we've largely doubled or tripled that, depending on 2022 or 2023, 14 billion, 18 billion next year. So it's a fast growing company overall. And I really like this business for their positioning in the overall e-commerce landscape. And no, I do not believe they can be easily replaced by AI at all, despite what the price action may lead you to believe. So I don't think that Shopify is necessarily cheap here, but I don't think it's either they're expensive. It's fair to be building a position in the company. And recently, just today, as a matter of fact, I did start buying Shopify at about 113. And I have a target for DCAs. If ever we somehow come back down here under 100 towards 90 or 80, I'll be further building my position, as this is indeed a company that I want to hold at least for the next, 5+ years, because of just their strong competitive advantages in the space and the fact that they cater to a wide audience of clients, anything from very large enterprise clients down to the individual autonomous entrepreneur that's just starting a business making candles or whatever it may be, right? So very strong company. Valuation, in my opinion, is fair. It's not super rich. It's also not super cheap. It's kind of right there in the middle. Could it be cheaper? Yes, but their growth rates kind of speak for themselves. Average analyst price target is in the mid 160 to 170s. If you are a Shopify shareholder, I would indeed be very happy with this report, and I will be adding to this position myself personally over the next few weeks if we continue kind of dropping right there. That's everything I have for you guys for Shopify. Hope you enjoyed. Now, company number 2, AppLovin. So AppLovin came out with their quarter. We know that they've been down recently because of some short seller reports, for which, since those short sellers have apologized for reporting inaccurate information, the company, to the lows that we saw just a few weeks ago, is down 50% from the highs. But AppLovin is such a fast-growing business. A lot of people like it, and a lot of people who bought this one early back in 2024 have made a lot of money so far. But if you are looking to buy the business now, after this current quarterly earnings report, is it still worth it, or has the easy money already been made, and should you maybe be looking for something else? Well, let's have a look at some of their numbers, guys. And, first glance, they were staggering. 9.89% beat on EPS and a 2.84% beat on revenue. Now, keep in mind, guys, this is a $154 billion company. And they're only generate, I say only because it's not that large in relation to the market cap, right? It's a $154 billion company. And what do they do in terms of revenue? They don't do that much. And as a matter of fact, they only do about $7-8 billion for 2026. But you can clearly see EPS is in a massive ramp cycle right now. And the revenue is also in a mass ramp cycle too. Through this year into 2029, revenue will be doubling. Now, this company, although it's a very strong top line revenue growth company, the big story for AppLovin is the margins that the company is able to deliver. The margins are absolutely ridiculous, and that's what we're going to focus on today in our analysis. So moving on into AppLovin Corporation's numbers, in terms of the numbers, they beat the revenue, they beat the guide as well by a wide margin, they beat the EBITDA numbers, they beat your EPS, and also beat free cash flow at the top end right here by 39%. That's not easy to do. They gave some guidance. Q1 revenue guidance beat by 3.5, and the Q1 EBITDA guidance beat by 5.7. Very strong here, guys. There's really nothing bad to say. Now, you'll see two categories right here, revenue and then revenue X apps. So they'll provide a revenue number of 21% year-over-year growth, and then a 66% figure for revenue X apps. Now, it's called AppLovin because they used to not only do advertising, which is their big, that's all they focus on now, essentially, is their advertising business, but they used to also own a large amount of apps. They would either develop themselves or purchase from other people and run those mobile apps at the same time. Now, although that was a very good business for them in terms of revenue growth and things of that nature, it just was not as profitable nor as fast growing as the app business. So just a few quarters ago at this point, they actually sold that business to a company called Triple Dot for $900 million, which is why you see a bit of a discrepancy right here in these two revenue figures. But moving forward, we will only be using the revenue X apps figure, but since now we're kind of comparing against quarters where they did have revenues from the apps division, that's why we're giving the breakdown here, and the company also speaks about this too. You can take a look at the EBITDA margins. Look at these EBITDA margins, guys. From 2023 to where they are right now, especially after spinning off that apps business to Triple Dot, look at the EBITDA figures right here. That is crazy. 84.4%. You can see when they sold off the business because the numbers become the same, whether on revenue and EBITDA, right? The numbers become the same. Before they were different, now they're the same because it's only the advertising business. Look at your net income figure, 66.5%. You cannot find many companies in the market, guys, that deliver 66.5% net income margins, substantial, and 68.2% free cash flow, which is also very solid. $2.5 billion in cash equivalents, $3.5 billion in debt. So the company is in a very good financial position in terms of the balance sheet as well. Take a look at more numbers. Look at these revenue growth metrics. Very solid overall. The company references it's 66% year over year because it's only referencing the advertising business. As a matter of fact, Look at this net income. Look at these net incomes, guys. From 2023 through now, 66% net income margins. That is absolutely ridiculous. And if you take a look at EBITDA margins as well, which the street absolutely loves looking at, 84%. Look at how fast this absolute number in dollars is climbing. Really, really staggering. Cash flows from operations and shares outstanding. Well, shares outstanding is your blue line right here. You can see that, yes, they are buying back shares. As a matter of fact, they did authorize during this recent quarter a new, or rather, they still have a $3.28 billion in buybacks authorized. The only issue is that it's being slightly offset with your stock-based compensation, which is why you don't really see this number moving. But at least they haven't been diluting themselves. And the free cash flow is growing so fast that eventually this number will be going down, right? They will be buying back more shares than they are issuing to current employees. So very solid cash from operations numbers going higher. It is truly a margin expansion story. There's just no other way to put it, right? Take a look here at your free cash flow. Look at this free cash flow metric, and your shares outstanding are actually flat or slightly declining. And this free cash flow number, because it's such a highly profitable business, guys, and they generate so much in terms of net income and so much in terms of operating cash flows, and they don't really need to reinvest much into the business. There's some fine tuning for some R&D for their algorithm optimizations, but it's not a very capital intensive business at all. So as revenue continues to scale at a very rapid pace, you will probably be able to see massive increases in free cash flow, and as a result, a reduction of the share count over time, which is very interesting. The CEO was asked, of course, about the AI narrative, which, did contribute to pulling AppLovin down recently. There was a short seller report that came out. Thereafter, they got caught up in the software trade because at the end of the day, it is software, packaged software for advertising. But then again, I mean, they do have an 8% share in 8% market share in mobile, and over a 85% share in their true niche, which is mobile gaming ads. Over 1.4 billion daily active users on the essentially, they're a advertising network, right? So the 1.4 billion daily active users would be anybody who's using the apps, mobile apps, where you would eventually see an advertisement that AppLovin is running the backend for, right? So that's a very staggering number right there in terms of daily active users. Now, that being said, CEO talking about the impact of AI narratives on the stock price, he argued that a rising bid density can expand the overall pie, even if AppLovin wins a smaller share of impressions, because the company can collect a fee when other bidders win inventory that AppLovin's model values less. In his view, improving auction competition helps publishers earn more, which supports more user acquisition and overall ecosystem growth. So essentially saying that the TAM is indeed expanding for these companies. Their closest competitor is Google in terms of Google's ads on mobile devices, but AppLovin has a very pure niche right there, and they are arguably able to deliver better and revenue per user than even Google's software is able to do. On AI's impact on game creation, because we know that a big part of their niche is the mobile gaming ecosystem, the CEO rejected the notion that easier game development from AI, we know that AI is able to develop games now, mobile games, right, would reduce the value of AppLovin's platform. Instead, he said lower creation costs should increase content supply, making discovery scarcer and more valuable. So in essence, right, if it's easier to create games, there may be more games that flood the marketplace. As a result, each and every game from a publisher may have more problems getting visibility because there's going to be more supply of games, right? And as a result, if you need visibility, well, what do you have to do? You have to run advertising. And who runs advertising better than most people in the gaming ecosystem? And who has the lion's share of the market? Well, it's AppLovin. So they're very well positioned to take advantage of what's going on in AI, and they're using AI to optimize their overall algorithm too. So very solid earnings from the business. Nothing really in terms of a big red flag. Now, that being said, in terms of valuation at $450 right now, you're getting a nice discount from the top. But what about the discount in terms of valuation? Well, they're trading at a 42.5 forward priced earnings, but they are growing EPS 40% on average per year, which is not easy to do. Of course, these growth rates will not last forever, but they will last through at least 2028 and probably even 2029. Now, the PEG ratio right now is a 1.06, so not that bad. You might look at the PEG ratio and say, oh, that's pretty cheap. The company's pretty cheap, right? I'm getting a really good discount on it. Well, if you look at price to sales, it's a 19.71. And even if you use forward price to sales here at, for 2028, you're still paying 12 times sales for 2028. So the valuation, guys, is a bit mixed. If you use the PEG ratio, you can't trust this one forever because the EPS growth rate will be coming down. And the revenue growth rate, I assume, it's also, well, not I assume, it's not going to be able to grow at 29% forever, right? So AppLovin right here, in my opinion, guys, once again, you're not paying much for the 3 forward years of growth, but beyond that, that's when the questions start to kind of come about, right? So AppLovin is a company for me that I wouldn't make it into just for me personally, right? If I choose to buy this company, which I don't really see a problem in buying this company right here, business is executing flawlessly right now. They'll be buying back more shares, which will be able to keep this EPS growth rate, artificially high, as many other companies do, but they are growing very nicely in an organic fashion as well. That being said, they control a decent portion of the mobile ads networks that they choose to run their platform on. Price to sales, a little bit higher, right? So AppLovin is kind of like Shopify, right? It's not necessarily super cheap, depending on which valuation metric you use, but it's also not extremely expensive. Could we be able to see some nice share gains if we buy from here? Most likely so, if the business keeps if the business keeps executing, right? But you would be looking for a little bit of margin expansion to go back up there because they can only increase revenue so fast. This business as well gets a premium valuation just because of how well entrenched it is in its niche. So the company is a very solid company. I don't own any AppLovin myself, but if I were an AppLovin shareholder from previously, I definitely would see no reason whatsoever to sell. It's just that starting a new position right here, well, eventually the law of large numbers is going to catch up with them. But for the next 3 years, you do have some pretty good visibility. It would not be a core, fairly large position, at least for me. But would I mind dipping my toes into AppLovin at these prices? No. Strong business model, and the valuation isn't egregiously expensive. Let's just put it that way. Your profit margins are indeed quite staggering, and they do have a good business model running behind everything. That's everything for AppLovin. Hopefully you guys enjoyed that. Now, lastly, let's take a look at company number 3, which is going to be good old Vertiv Holdings. So Vertiv coming up massively after their earnings, guys. A huge beat by Vertiv, which just goes to show this is another company that is telling you the AI trade is nowhere close to being done. In terms of your earnings releases, 5% beat on EPS and a 0.15% beat on revenue. Now, if you guys don't know what Vertiv does, they do everything inside of the data center. They have many offerings, everything from chilled water solutions. So they will help you build out all the piping and all the just liquid cooling solutions that goes into the racks, et cetera, et cetera, et cetera, and even some liquid cooling solutions if ever you are running things such as, AC cooling systems and things like that, right? So they do a lot of some HVAC purposes as well. Liquid cooling options for data centers in terms of just the actual rack. So they compete with somebody like SMCI or Dell or things of that nature, right? And they also do a lot of power management solutions too. So a lot of cooling solutions, management, thermal management, et cetera, et cetera, et cetera. So a company that's very well positioned to expand its offerings because of just the sheer amount of data centers that are being built, and it does have some best-in-class products to kind of serve that little niche that it operates in, right? Which is a very big niche moving forward. The only thing is that, once the construction of the data center boom is going to be finished, well, you probably won't need to replace any of these systems, in short order. So Vertiv is one of those other companies that, for now, it's very in theme, right? Very, very hot theme overall. The business is executing flawlessly within this theme, but once again, it's another business where beyond the massive scale out of data centers right now, which to be fair will probably last for another good 2, 3, 4 years, it's just, is it a company you really want to have beyond that? Like, we can make some money in this company for now, that is for sure, nobody's doubting that, but beyond that, right? So this one would be a thematic trade for me, not necessarily maybe a 10+ year hold, because after this massive ramp, it raises the question, right? Will they be able to sustain these massive revenue and EPS growth rates? But for now, you got to give it to them, got to give it to their flowers. They're executing perfectly, and their product suites are just very high quality and very well made. Now, moving into more earnings highlights here, the reason that they're up 24% after their earnings, guys, is not necessarily because of this quarter. As you can see, the revenue came in roughly flat versus the estimates, and the EPS also was a slight miss versus the estimates currently, but it was the backlog. The backlog was a massive $15 billion backlog, which is an increase of over 2x year over year, 109%. Organic orders, the order book, 252%. So that $15 billion of backlog is absolutely massive, guys, right? It absolutely guarantees them that they have, this revenue pipeline here through 2026 and 2027, which is a full year. And I wouldn't be surprised if that backlog just continues to grow and grow and grow. Adjusted free cash flow was also decent at about $910 million, an improvement of 151% year over year. The guidance as well was a reason why this stock is up so much. The massive backlog and the massive guidance. Look at this beat on revenue guidance. Absolutely massive here, guys. Something like a 10% beat, 10% increase on revenue guidance. 13.5 is the midpoint. 12.4 was the estimate. Adjusted EPS guidance as well. Talk about a massive beat here too, right? Over 10, 12% beat right there. The estimate on EPS was 5.33, and now the consensus is about 6.03. So massive beat right there on EPS. So that's why the stock is being re-rated to the upside. A lot more revenue than was formerly anticipated for the full fiscal year, and a lot more EPS as well. So please keep that in mind with a very decent free cash flow number. Most of that will be coming into the back end because we see that their Q1 guidance wasn't all that. I mean, they came in roughly a little bit, a little bit in line, right? Adjusted EPS came in right in line, maybe a little touch better than the estimate, and revenue as well. The midpoint here, 2.6, was slightly better than the estimate. So this Q1 guide is not the reason. It's really the full fiscal year guide. So you would assume that the bigger portion of the ramp, the bigger portion of these revenue and EPS excesses come Q2, Q3, Q4, right? So very strong quarter by Vertiv. Nothing bad to say of the company as well. Here's just a few pieces of commentary. Enormous power and cooling facility upgrade opportunity for AI data center deployment. We expect AI power and liquid cooling system development in the white space of existing data centers to grow at a 40% CAGR over the next 5 years. Additionally, we forecast greenfield data center capacity builds to grow at a 23% CAGR out to 2030, reaching 250,000 megawatts from less than 100,000 megawatts in 2025. So once again saying, yeah, they may have not they, but the market may have underestimated just how many data centers and how large the scale is going to be over the next 3 to 5 years. And I mean, if you can't take it from the hyperscalers, right, you just got to take it from some of these connectivity plays, whether it's names like Celestica, whether it's names like Credo, whether it's names like right here, like Vertiv Solutions, whether it's the memory names like Micron and SanDisk, right? Everything inside the data centers, inside the racks, whether it's the guidance from AMD or from Marvell or from Broadcom or from NVIDIA, right? Everything inside the data centers is growing at such a massive clip overall. So the AI trade is definitely not dead, and these guys have tremendous visibility. You take it from these semiconductor equipment manufacturers like ASML or LRCX or AMAT and many others that I'm not going to cover right now, right? But everybody, TSM, right? They're all telling you the same thing. The visibility for the next 3 to 5 years is very good. Finally, we estimate that upcoming upgrades to the 800-volt HVDC power architecture and liquid-to-liquid cooling solutions will more than double the system design value. Combined, these opportunities point to a 30% total addressable market compound annual growth rate for AI data center power and cooling solutions from 2026 to 2030, and that is arguably what the market is kind of giving them right now. Through 2028, you got about a 24% revenue growth rate here. Now, the only thing that I would like to see Vertiv do a little bit better, and it's no fault of their own, right? It's just a question of scaling the business a little bit more, is improve the margin profile a little bit more, right? Now, nothing bad to say about the margin profile. It's just that the gross margin's kind of been stuck here at about 35, 36. You would like to see them improve that a bit more. But then again, they are a product company, right? It's tough to do. They're not a service company. Operating margins have been moving in the right direction too, and net margins have been steadily improving. So if they can just improve these margins a little bit more, which they've been working very hard on doing over the last 2-3 quarters, as you can clearly see right here, they will be in a very good position. They're already in a good position here, guys, but they'll be in an even better position to drive more net margins to the bottom line, more free cash flows overall, and it's going to make it more of a lot better of a well-rounded business rather than a top-line growth company, which it is right now. So at $250, guys, it's currently trading at a 41.5 forward price to earnings with a 1.4 peg, which is indeed great. A forward price of sales of 7. Free cash flow yield is not quite there yet, but then again, most of the juice is here, right? The fast-paced revenue and EPS growth rate. So objectively speaking, is Vertiv Solutions cheap up here at $250? No. The last time we said that Vertiv was a buy was down here in the mid-100s when they had these same growth rates, except for it was trading closer to a 1 peg, right? Then you could arguably say, yes, the company was cheap and you could possibly make some decent money by buying some of these, tightening up buying the tightening range right here that happened, right? This very nice consolidation phase, kind of like what ANET went through and many others that had the same charts. It was also a very nice pullback. The pullbacks to the 12 EMAs on these companies and the backtest, the resistance here was the key area. Now you are kind of extended, but this is another one of those companies where even though the move is extended right now and you may not be getting the best possible price, can there still be money to be made here? Is there still money to be made here buying it at 250? I mean, arguably the answer to that question is indeed yes, because they're just growing so fast and the valuation does have a little bit more room for expansion so long as they keep executing. The business is poised to do very well. It's just you're not getting the best entry price anymore. So this is when you see a company that has fantastic fundamentals. The valuation right now is fair towards cheap. You can't say it's extremely cheap right now. It's fair, leaning towards the cheaper side of things, but nowhere close to being cheap in absolute terms. And they will just continue growing, right? So maybe this is another one that you kind of keep on your watch list. If you're a Vertiv holder, I see no reason to sell whatsoever because you are really getting the best compound annual growth rates if you bought down here, right? But if you're considering buying up here, well, is there that much meat left on this trade? You probably still make some very good returns, right? But not the excess easy money returns that people might have had buying this one, you know, anything under 130, 120 bucks, or even the people that bought back here 150 on the pullback, leaning in to the big build out over the next few years. So phenomenal company. Valuation, in my opinion, is fair. Would it deserve a buy from me? You guys know my style, right? I don't usually buy big breakouts like this. I usually wait for solid companies to pull back, and they usually always do pull back for XYZ reason, right? So those are my thoughts on Vertiv. Hopefully you guys enjoyed. Congratulations to all Vertiv shareholders out there. I do not own this one personally, but I'm very happy for every one of you that does. So congratulations to all Vertiv shareholders, and that wraps up our earnings presentations for the day. Hopefully you guys enjoyed those. They were a bit shorter, but I probably could have made them even shorter, but I thought I did a pretty good job right there. I'm trying to keep these videos as short as possible. Now that we're through the earnings, let us go back into our index analysis and see what's going on here on the SPY as it continues to barcode. So let's get into the technical portion of the video. All right, so we're going to run through these quickly because no price action has changed, guys. The SPY still barcoding at the highs right here. They're trying to go for the upside breakout. The futures are looking good right now, but no guarantee that that's going to hold up into tomorrow's action. That being said, lower support area is still the good old 685 down to about 680. No red flags whatsoever. The bulls still retaining most forms of control on the weekly time frames as well. You can see there are no breakdowns right here. Your line in the sand levels remain below support right down there, 675. So as of right now, the SPY is just in an accumulation period, right? It's just been flat for a very long time. The better S&P, right, has been the equal-weighted S&P. The equal-weighted S&P continues to hit new highs, and that's what really tells you the market is overall healthy. You have more advancing names than declining names. It's just the weight of the regular SPY, the weight of big tech and other tech companies, that is what's been holding the actual SPY back, so keep that in mind. Moving on to the QQQs right now, the pain point of most of the market. You can see we're nowhere close to the all-time highs, but the bulls reacting nicely from support right now, 613 to 605. It was a daily downtrend, nice bounce, 50+% bounce. They got to change the trend, and hopefully they are able to use the support level to kind of do it, right? 612, then about 604. No red flags. The red flags will really come if you flush these line in the sand levels, 596 overall. The weekly just remains some form of a very awkward tightening range. Some people would argue that they are breaking down, yes, but unless the entire market breaks down, I don't believe you'll get a flush of the Qs, so keep that in mind. It is tied into the overall SPY at the end of the day. It's just technology has been very weak. And overall, I mean, as we continue to consolidate higher here, or consolidate sideways on the monthly time frame, I mean, it's just been 4 months of sideways action, accumulation. One would argue that on the monthly time frames, it's a bull flag, and you're waiting for the 12 EMA to catch up. Very nice resilience, even though some pockets of the QQQs have been getting destroyed. The overall ETF, I mean, if you're an ETF investor, you're not really down that much on the Qs, right? Which is why sometimes it's good if you do have those ETFs, but you can clearly see some divergence here between large cap growth ETFs like SEHG. SEHG coming really nicely, guys, into the 12 EMA. Large cap growth might just be ready after 4 months of consolidating. Dividends, though, the dividends has been the big theme, right? Value and dividends, and we touched upon this at the turn of the calendar year, where we were saying XLP, XLE, dividend players, watch out for it. SHD was my position, and I don't even really need dividend stocks in my portfolio. I'm more of a growth investor, but I saw a key theme coming into play here for 2026, and as a result, I did participate. Now, the gains on these dividend funds are not substantial by any metric, right? But, you know, those buys issued early January, they're already up 15%, and that's a pretty substantial move for just a classic dividend fund right there. Very nice rotation, not a big position for me in relation to my total net worth holdings, right? But it was just a little theme that I was willing to play, and so far, so good. Moving on to XLF. XLF also plummeting right here after the banks came down. So, you know, they're flushing the line in the sand level, 52.81. So, unfortunately, the bulls just not able to get the daily uptrend going and losing the support range. So, in the event, we come down a little bit lower. 200-day EMA is right below us right now, 52.5. Well, you're going right back down here where we were talking about, right? 52 down to 50. This was a plausible scenario, and it appears as though they want to go for that possible decline right there. The monthly ETF just shows, the monthly chart right here just shows a casual monthly higher low being attempted by the bulls coming down to the monthly 12 EMA. So I mean, interesting. I'll be interested in some of the banks, right? Like JP Morgan back down here around the 290 range. You'll see that they're also doing a bit of a sideways with a slight bearish downside bias into the 12 EMA, consolidating for a long time. I'm interested in JP Morgan down there, but we can find maybe some other opportunities. Bank of America, if it pulls down there, could be interesting as well. You guys already know my thoughts on Visa, MasterCard. No need to talk about them all the time, but Visa, MasterCard, phenomenal buys down here. And SPGI for me is a clear DCA, even though it's wildly out of favor. We covered their earnings the other day. I started buying in the mid 400s. I'm going to buy a little bit more down here, and if they come down here to 360, this is just a long-term position for me, right? Not looking for any swing trades, no call options. No, just building some shares that I plan to hold for the next 5+ years in this phenomenal company, right? So keep that in mind. Moody's as well. If you're buying SPGI and Moody's, you're not looking for super fast V-shaped recoveries from here, although they would be nice. You're not looking for call option trades. No, you're just looking for very strong companies with very wide moats that could be an interesting position if you're a long-term investor and you want to hold these styles of companies. They're not for everybody, I do agree, right? But they can be a nice backbone for to offset some of the growth companies in your portfolio overall. You know, so please keep that in mind. They're trading at some of the lowest valuations that they've had in years and years and years at this point. Moody's reports next week. Moving on to XLV Healthcare. XLV Healthcare doing absolutely nothing, still stuck in this little range of price action right there. The weekly shows that best, so we're either looking for the breakout or breakdown. If we get either or, there could be some nice opportunities. If you get the breakout, you're looking for the breakout, retest, and run trade. And then, conversely, if you get the breakdown trade, we're just looking for the monthly higher lows, right? It was a nice monthly downtrend. If you do break a little bit lower, you'll be looking for the support to come into play, 150 down 145. This is the entry for any new healthcare longs if you do get the breakdown. Moving on to semiconductors right now. Semiconductors, very nice performance today. It was largely led by NVIDIA, Broadcom, but also Micron, some of the semiconductor equipment manufacturers too. But also computer hardware, which includes your STX, your WDC. SanDisk was up 10.5% today as well. So that led to a big move here in the SMH. So full recovery right there. Very nice engulfing move. In the event they get rejected from here, they got a lot of space to reset the daily uptrend. And overall, the weekly looked pretty good here. They perfectly backtested our weekly 12 EMA and looking for a bit of expansion. So semiconductors remain very strong. Monthly chart remains very strong as well, although being in slight overbought conditions right now. Very strong, and there's some interesting rotation going all over the place right now, yeah? There's still some great opportunities if you don't want to chase companies, even though Micron and SanDisk, objectively speaking, are indeed undervalued in relation to their forward earnings estimates, right? They trade at very cheap, like arguably single-digit PEs, if not low double-digit forward price to earnings ratios, right? If you take a look here at one thing that was saved, the reason that we were up so much today was a piece of news that Micron released during a nice conference right here. Micron at Wolf, the new NAND fab, is on track for the first wafer outs in second half of 2028, and HBM4 customer shipments are ramping in calendar Q1, a quarter earlier than the December timeline. The CFO also flagged demand running well above supply and sees supply tightness lasting beyond 2026. So it seems that every week or so we get more information that, it's more of the same, right? Just there's a lot more demand than there is supplies, and most of the fabs newly being built by companies such as Micron, well, a lot of them them only come online like 2027 and 2028. So keep that in mind. There may just be more meat left on these trades for some of the memory names, right? Now, chasing them when the chart looks like this is obviously very tough to do, but if you're just buying on based purely off the narrative and purely based off of the supply shortage, well, you know, you basically put in an amount of money that you're willing to put towards that theme, put towards that narrative, and you kind of have to temporarily forget about the price action. Not my favorite way of doing things. Most of the time, I am a bigger fan of, even when companies are running super hot, they do tend to consolidate towards EMA structure or whatnot. We saw that same period of time happen right there, but super strong for a lot of these memory names, can't lie. IWM Russell right now, the Russell down about 0.45 today. Bit of a retracement. You can see here, daily downtrend. You got the nice engulfing move overall, and now we are just looking to establish some form of a short-term higher low and possibly move a little bit higher on this growth trade. The growth trade's been performing well, right? The Russell year to date is up 7%, so that's outperforming the SPY and the Qs. It's like a very bifurcated market, right? Large cap growth, okay, has been underperforming everything. What's been outperforming? The two opposite ends of that trade: value and dividend names, and then super not so speculative, but small and mid cap names, right? The two ends, but just not large cap growth in the middle. So please keep that in mind. The weekly on the Russell looks great, looking for further weekly uptrend expansion, and the monthly is also gone at this point. So I am participating in the small cap trade. I just have individual names instead of the Russell overall, so please keep that in mind. But another day, right? Another day, and I mean, look at the XLP, XLE continue to be very, very popular trades. But shout out to utilities. Utilities is coming back a little bit. Utilities trade is also a very popular one for me. We talked about it many times to start off the year. You know, names like Vistra, names like Next Era Energy, names like Duke possibly as well. There's so many, right? Names like Constellation Energy as well. Look at these charts, right? If they're not bottoming out soon, they're just expanding. A lot of these names that have direct narratives tied into the data centers could be wildly popular over this year, so please keep that in mind. The VIX still remains a little bit elevated in relation to, you know, where we were just a few months ago down here in December at about 14. So the VIX remains slightly elevated, as you do have pockets of the market that are moving very wildly, right? You know, some software names, some of these larger cap names, right, down, and even the banks, right? Banks coming down 2-3% on a day. Software names down 4-5-6% on a day. Large cap names, you know, like names like Microsoft, right? Microsoft in other markets sometimes only moves like 0.5% a day, up or down. And recently, you know, a lot of these tech names have been moving like 2% per day. So the volatility has been here and has been maintained quite high. So keep that in mind. Good opportunity, good environment to be selling options in, that's for sure. Moving on to now the gold and silver trade. So gold is trying to go for it, man. They're trying to go for the daily breakout. They successfully closed a candle here above our structure, which is about $5,050. So they're going for it. So now you have a bit of a confirmed breakout. It's a slow breakout, and any big candle could obviously just send us the other way. However, it is now a confirmed breakout of that key area of resistance structure, so please keep that in mind. Now, that being said here, guys, if we were going for a swing trade, right, you got a clear stop loss area. Daily uptrend is now reset. As we said, right, when they gave that full flush of the most recent daily lows, well, the V-shape was kind of out of the question. That's just not the usual probabilities when something gives back an entire move like that. They usually go for the two-step recovery process, which they're successfully doing right now. So stop loss goes right here. Entry is arguably now your first take profit area, although not the best in terms of initial risk to reward, right? If your stop loss is all the way down there, because that loses the structure, it's about like a 1.2 now at this point. However, carried to the higher take profit. This is take profit number 1. Take profit number 2 is 6,000. Now, you wish you would have had better risk reward on that, but they would have had to turn the daily uptrend down here. And then you would have had a better stop loss, right, with a better total weekly reward target. But that's not what the price action gave us. You kind of got to play with the cards that you're being given. Weekly uptrend is still very nice, very healthy. So the bias does remain long right now in spite of being weekly overbought conditions, monthly overbought conditions too. The bulls control all the time frames. Again, monthly, weekly was never a question. They lost the daily temporarily right there, but then they got it back. So keep that in mind. Silver is not moving quite the same, although you could take silver as a proxy trade from gold, assuming that this gold daily breakout continues higher. You could kind of mirror that trade on silver, although silver has not yet reformed the daily uptrend such as gold, right? You would have need to see this Similar to gold, that's not what happened. You're still in a daily downtrend right there, and the bulls are trying to get it back progressively. So silver, unfortunately, the stop loss would still be all the way down here at 64. Your expansion target would be similar at about 121. It's a ways away. There is a trade here, but it's kind of like a carry trade from gold necessarily. As silver's price action right now isn't as obvious as it is on gold. That being said, respecting the 12 EMA on the weekly and the monthly time frame is not looking too bad. They came right down here. Maybe some of you guys were able to pick it up when they came closer, right? Picking it up here with the premise of possibly descending into the 12 EMA, which is what we were saying when it was kind of crashing down there. But silver, I mean, got to give it to them, right? They're holding a lot of the time frames, so keep that in mind. On to Bitcoin and Ethereum. Bitcoin and Ethereum just continue to be an absolute disaster. We will see if they're able to protect these kind of sell-off liquidation lows at 61. But I mean, the bears control everything right now. Still in the hunt of for a daily uptrend on Bitcoin. No daily uptrend, no weekly uptrend. The monthly uptrend has also been lost as they flush the lows right here. So there's nothing really to do on Bitcoin. There really isn't anything to do other than you attempting to call this the absolute bottom and catching a falling knife of sorts, right? Now, some of you may argue that there is a swing trade opportunity here if you want to call this bottom with a stop loss and say that's your true bottom and go for a bit of a weekly upswing recapture into the 80s level. You can attempt that. The timeframes don't show that that is indeed what's going to happen. Usually you would wait for the daily uptrend break on something like Ethereum, put the stop loss there, at least you have time frame confirmation, and then you'd be targeting the expansion back into the high $2,000s to $3,000 range. Because right now you're basically just guessing, all right, well, maybe this is the daily high or low, and maybe they actually do it. I'm personally of the opinion that sometimes it's better if you want to have the most clarity to wait for your time frames to confirm the trend. That way you know who's back in control. But as of right now, the only thing you can possibly do on Bitcoin and Ethereum, we've said it for a while now, is just accumulate for long-term positions if you believe in the crypto thesis. So keep that in mind. That's everything for your overall market rundown. Hopefully you enjoyed. Now let's move into our big tech names. We're going to spend about 10 minutes on big tech and then another 10 minutes on the biggest gainers and losers. Okay, so moving into Apple, the only company that hasn't spent hundreds of billions of dollars on CapEx remains one of the only companies that's been doing well across the big tech landscape, right? Daily uptrend confirmed, attempting still for the higher low. No breaks up here. In the event that you lose this higher low, 271, that would be a temporary daily downtrend, would mark the top of the weekly move. We are into an area of support right now. The bulls with a nice engulfing move to the upside. So you might just be looking for a bit of uptrend continuation, right? This is still an inside candle in relation to last week. Everything is looking quite good on the price action structure, guys. It's only the best time to buy Apple is not here. It was indeed down there, right? Now, some people may argue, well, can't I just go for the breakout trade or something like that? You can, but the risk reward, in my opinion, is just not as optimal as that 12 EMA backtest right there when you're really looking for the cup and handle. It was an easy trade, right? Now the trade is kind of like midway through because any entries back here, your first take profit would have been there and you're kind of almost there, right? Now anybody who enters now, you have to extend your price targets into 300, which may be logical for this cycle on Apple. That being said, at 270 right now, the valuation is somewhat expensive. So Apple remains in a, just a hold position for me. I'm not selling any shares. At the end of the day, it is Apple, super strong company. They had great earnings, great visibility for guidance for this year entirely. So keep that in mind. Just a hold for me, not a buy, not a sell. Moving on to AMD right now. AMD literally 0% change on the day. They went up by a penny. So that's pretty interesting. You don't see that too often, right? 230 down about 216 is the good old resistance range that the bulls are struggling with right now. It is in the context of a daily downtrend. So in the event that this is indeed just a lower high and you have to revisit these lows are probably best buying opportunity in my opinion. Anything under 200 at this point is quite solid for AMD. Long-term thesis is still very much intact. It's just they've been consolidating now for a very long time, right? It's just been this awkward, very choppy monthly consolidation, but you can clearly see, right? Best area right now on AMD, 190 down to 170. So if it moves lower into the low 200s, that's when I can nibble on some shares and also when I can sell some put options down here to play the volatility. At 210 where it stands right now, valuation is still very compelling for the upside thesis. 35% revenue growth per year, 35% revenue growth, 35% EPS growth as well. Super solid metrics, guys. AMD is about to embark on a massive ramp, and I'm all for it. Moving on to Amazon right now. Amazon down 1.39%, still not able to shake off the post-earnings weakness. That being said, we are losing one key area right here, 216 down to about 205, let's call it. If they keep losing that one, we're going to the lower one, 197 down to about 189. Excuse me, so please keep that in mind. Phenomenal business, guys. I obviously think it's been an overreaction on earnings, but no matter how much I say it's been an overreaction, doesn't mean that it's going to go up instantly, right? No, but I stay accumulating Amazon down here at 210. The valuation on a forward basis is a 27. PEG ratio is a 1.35. Very solid company. What they showed us during their earnings is, sure, there was a $200 billion estimate on CapEx, but Amazon, that's their game, right? They have just all their operating cash flows that they've generated, arguably, I mean, they did some buybacks a couple years ago and things of that nature, right? But for the most part, Amazon's a company that reinvests its operating cash flows into whatever it's working on. And this time it's AWS and the data centers. Formerly, that operating cash flow was reinvested into the expansion of the e-commerce business. And now you have a business that just has so many things to offer, right? Whether it's their new low orbit satellites that they got permits for their Project Kuiper, whether it's their medical and pharmaceutical business, right? Their telehealth business, which is growing, whether it's their grocery delivery business and just massive $400 something billion e-commerce business, the advertising business, AWS. There's just so much in this company. Their robotics division too. There's just so much in this company to love. And I am definitely a big fan of Amazon. So despite the negative price action, I will continue to buy here for the long term. 2027, December are all my LEAP contracts, so I'll also be playing those and also selling some put options under the market. Amazon's still one of my favorite buys in the market, despite the price action. Moving on to Google right now. Speaking about price action, Google is doing something that it hasn't done in a long time, guys. It's cutting under the 50-day EMA, right? So that's not too good. They're losing a bit of structure right there. Unfortunately, they gave back the earnings, the earnings dump into a pump, and now they're just giving the pump back. So price action continues to remain in favor of the bears on the daily. On the weekly timeframes as well, you might be looking at a bit of an unraveling here by Google. As you can clearly see, the RSI on the weekly is finally cooling off. Very nice. The MACD is finally curling as well on Google. So now Google embarking into its consolidation phase, right? You can argue that the stronger higher low is down there at about $300. That being said, if we finally embark into Google's consolidation phase, which I'm sure not many people thought would come, but I kept saying, nothing goes up in a straight line forever. Google got massively re-rated. The healthiest thing that they could possibly do is allow the 12 EMA to catch up and curl back into it. So many stocks follow this exact same pattern, guys, right? It's not a question of if, it's a question of when. So in the event that Google comes down into the high 200s, you may find me interested again. But up here around 311, 320, just not interested. Hasn't consolidated enough for me so far. That being said, phenomenal business. We covered their earnings. Nothing wrong with their earnings whatsoever. And the valuation up here is still a little bit high, right? High 20s forward PE, 1.9 on the PEG at about 330. It's dropped a little bit since, but you guys must understand, right? It's still high. Come back down to the mid 250s or the mid 270s, 260s, then maybe we might find some opportunities, provided that they're able to establish a nice area of price action around those ranges. Moving on to Meta right now. Meta down about 0.3%, still also not able to shake off the post-earnings sell-off. That being said, Meta is still super solid. Nothing wrong with this business at all. It trades at a 2026 forward price to earnings. It trades at a 1.17 PEG, which is super cheap for all this growth. Beautiful revenue, beautiful EPS growth. They guided for 30% quarter-over-quarter or year-over-year growth for the next quarter, which would be fantastic, right? Nothing is wrong with this business whatsoever. Just once again, large cap tech being very unfavorable because of the big capex efforts. Now, that being said, support stays planted 645 to 630. Overhead resistance 680 down at up to 707. So you're going to need a big push to get through this, right? If it's a big level, you need something big to crack through that big level, right? So they're going to need a really big push to get through this. We were hoping it was going to hold after earnings. It didn't do so, but it is offering some extremely nice, attractive buying opportunities for Meta. If you just take a look here, guys, at the price targets, right? The price targets are like midpoint of 856 and the highs over 1,000. We're under the minimum price target right now. Phenomenal business. If it keeps climbing lower down here, we will be adding some shares. Moving on to Microsoft right now, down 2.15%. Anything software, guys. Anything software, even Microsoft, right? Just getting completely obliterated right now. So Microsoft just getting re-rated to the downside. 410 and about 385 is your support range. And it's a pretty large support range, guys. It was all of 2024 lows. We are coming into the 200 weekly moving average on Microsoft. That doesn't happen too often, does it? As a matter of fact, you'd have to go back to the big bear market of 2022, or you would have to go back to 2012. to find Microsoft down there. So it does not happen too often, especially not at these valuations. Microsoft's trading for a 4.25 price to earnings at a 1.34 peg, arguably some of the lowest valuations that you've been able to find Microsoft at a very long time. That doesn't mean, even if they're weekly oversold conditions, low valuation, daily oscillating daily oversold conditions, it doesn't mean the move is done. You got to change the trends first. You got to change the sentiment a little bit. So we're looking for the bulls to get the daily uptrend going. Until that time, the bears are in full short-term control of everything, daily, weekly, and even monthly downswings too. So please keep that in mind. Great time to be adding some Microsoft shares to the portfolio if you still enjoy this company. Moving on to Netflix right now. Netflix down 3.15%. So they made an attempt yesterday at trying to get above the 12 EMA. Still unable to do it, man. This 12 EMA, right? It's a big rejection zone. And now, unfortunately, we're under the most recent area of support, 86, down about 82.50. That was the last area. We tried to get back into it, rejection, and now, unfortunately, guys, you may just be heading to this 200 weekly EMA at 75. Netflix is also a company that, other than this big 2022 bear market, it does not test the 200 weekly EMA that frequently at all. Matter of fact, before that bear market, you would have to go back to 2011. 2013 period of time, right? So it doesn't happen that often. Obviously, we know what's wrong with Netflix. It's the whole Warner Brothers Discovery deal overhang. Weekly, big oversold conditions. Once again, this is large cap tech. So large cap tech, I mean, if the rest of large cap tech doesn't catch a bid, don't expect Netflix to catch a bid either. I'll be on the watch here, $75 to add some shares into that 200 weekly, but the bears control everything. They control the daily, they control the weekly, they control the monthly. Until the time that that changes, and it all starts with this daily uptrend, we can't say that the lows of Netflix are in currently. But what we can say is that if we are DCAing as part of a long-term portfolio, there's nothing wrong with buying Netflix. If your plan is to hold this company for the next 3, 5, 7 years, etc., I don't see anything wrong with buying Netflix under $80 right now. Valuation is quite compelling. Moving on to NVIDIA currently. So NVIDIA up about 0.8% today, still holding, no breakout. NVIDIA has earnings Wednesday, the 25th of February, so that should be very interesting to pay attention to. Support stays put, 185 down about 178. Nothing really to report, right? The bulls are trying once again to build some form of momentum to the upside. We'll see if they actually get it. We'll see if they can go for the weekly breakout as well. As of right now, weekly and monthly consolidations are still in order. You might remember my favorite areas are like the 175 and a 160 range. It's an area that I like, either buying some shares or selling some put options, and it is one that I've been able to play many times and buy and further accumulate some shares right around that 175 range. It's a low 20s forward multiple and under a 1 peg. Fantastic growth for NVIDIA as a business. And it's very funny as the company, like all at the end of the day, right? You see companies like Vertiv, see companies like the connectivity plays doing really well. You see Micron, you see SanDisk, the memory plays doing really well, right? Who enables this entire trade for the most part? It's NVIDIA, right? Without NVIDIA, there would be none of this trade to begin with. So it's so funny that NVIDIA is kind of pausing here, but maybe, NVIDIA had its exponential rally, which it did, and now it's time for everybody else to kind of catch up, right? But the guidance for NVIDIA should be very strong, so looking forward to those earnings. Moving on to Tesla. Tesla actually on a nice little run right here, right? They had a daily downtrend going for them, nice engulfing move, reclaiming an area of support, which is 430 or 427 rather, down about 417. Nice move on Tesla. We'll see if they have it in them to change more than that. If they can get our daily trend change going right there, move into resistance, and you can get a bit of weekly momentum going, because let's be honest, they lost all of it, right? And that would lead you to believe that the monthly lows may just be in for Tesla. And they've been holding them really adequately. 405 down about 383 were those monthly lows. Very strong support from the bulls right here. Monthly consolidation into the 12 EMA. Looking decent, right? I wouldn't be going all in on Tesla right here, but swing trades for an expansion towards maybe 500, it's going to need the rest of the QQQs. It's going to need the rest of the big tech trade to kind of do this, guys. But there is an argument to be made for going for some swing trades on Tesla as they start to change these trends one after the other on the lower time frames. And you can clearly see after a nice period of consolidation, they may just be ready. So Tesla, not a bad bet, but the stop loss from that bet would be 383, and the target would indeed be above 500. So keep that in mind. Moving on to Palantir right now. Palantir down another 2.75%. Palantir getting caught up in the software niche as well, right? Even though that they are arguably the best company in all of software. I'm not saying the cheapest company by P. No, I'm just saying the company that has virtually no competition whatsoever. For me, that's what qualifies as the best, right? The company with the strongest moat, strongest competitive advantages, a product that nobody else really has, is arguably Palantir, right? You know, when we're talking about, we're not talking about the trillion-dollar companies, right? But Palantir is just such a solid company, doesn't really matter. One could argue that, well, it's because of the valuation. The valuation is always high, and we've been saying that on the channel literally for the past year. We were saying, you know, Palantir is expensive. Eventually, they will have a big pullback period, and at that point, you will have to evaluate whether you want to buy the company. Well, here we are, the big pullback period on Palantir. Now you have to evaluate whether or not you want to buy the company. Further support to the downside remains about 130, then about 118. So you're getting a nice discount on Palantir. By no means is it necessarily super cheap, but at 135, it's 106 forward price earnings ratio. That being said, guys, it's a 2 peg right now. So it's no longer a 4 or 5 peg because the revenue growth and EPS growth reiterated by Carp are absolutely nuts. It's a 2 peg. Price to sales is still way out of proportion, but it's a unicorn business, right? I do not mind, and I haven't said this in a long time, I do not mind picking up a little bit of Palantir down here, 130 down to 120. But if you are doing that, you have to assume that if the market continues to be unfavorable towards software or continues to bring down Palantir due to valuation concerns, you have to assume that your DCAs may have to last you down into the $100 range. But nice consolidation period for this company. Nothing is fundamentally wrong with the business, just being caught up in that software trade. On to SOFI right now. SOFI down 2.97% again. So same thing, right? You had a nice little bounce recently, little bounce, but they need to change the trend. So far, though, the bears are in full control. You might just be looking for a higher low into the flush. Right now is like go time for the bulls. This is where they have to prove it, right? They had a okay size bounce. It's like a 35% bounce from the lows. Nothing to scream home about. If anything, that does favor a bearish rollover, especially when you're using this area as resistance, 21 up to 25. They're now using this area as resistance. It was a very big level, very big level. And unfortunately here, there's not much, right? Most of the biggest support comes down there at about 17 out of 15. So we're in a kind of a dead area right here. It's up to the bulls now. It's like do or die for them, right? Either they can change the daily uptrend and get back into this area and create a bit more space above these lows and set some weekly higher lows and try to make a weekly trend change attempt into the rest of the early portion of 2026. Or the bears will just be too strong and they will carry you lower into the next deeper area of support. I am a decent buyer of SOFI down here at $20, as we were saying, and I'm also a decent buyer of it if I have the DCA down there. I think we're finally getting a nice pullback on SOFI down from the highs of $32. It's off nicely from the highs. We covered their earnings and the valuation of the company down here at $22 is pretty fair in my opinion. And so as we drop further, it'll be a nice reload area for SOFI overall. Moving on to Uber right now. Uber down 3.39% for no news whatsoever. They had great earnings, but the stock just being in that unfavorable category of just large cap tech, right? Daily downtrend is in favor of the bears right now. Everybody knows. Weekly downtrend is also in favor of the bears too. So please keep that in mind. I am buying a little bit of Uber here at 71, but I also fully recognize they may, if the market continues to be unfavorable towards these names, they may indeed revisit the low 60s, right? Which is an even stronger area, right? So this is the top end of resistance. This is a huge area. We're talking about 2021 highs right there and the lows of 2024 and 2025. If they do that, it's not going to look great for momentum at all. They'll be giving everything back. However, the valuation for 3, 5, 7-year holds out on Uber will look extremely compelling, as right now, below 75, you're trading at a 22 forward PE, a 1.11 peg. But you know, sometimes, guys, the fundamentals don't matter on some of these stocks. The technicals don't matter. They just keep selling off because the sentiment is not good. So I get it, right? I'm in a lot of these companies myself, and it's just a lot of these companies are selling off because of sentiment, not necessarily because they reported bad earnings or whatsoever, right? No. Earnings were quite good, so I am a fan of Uber. It just may take a little longer of a time, right? So I'm not buying any short-term call options or things of that nature because the price action doesn't really favor that right now. Only thing I'm doing is increasing my long-term holdings little by little. Moving on to TSM right now. TSM, very strong day by TSM, 3.4%. super strong. Any pullbacks on TSM right now looking for a higher low, anything above 346, or rather, you can pull back into 346 and be looking for a higher low. A little bit of confidence right there. TSM very strong. Daily chart, weekly chart, clear weekly uptrend right now. The bulls in absolute full domination mode on this chart right now. TSM has been one of my best performers in my long-term portfolio over the past few years to begin with, right? But even recently, as a lot of the other tech companies aren't doing anything, or a lot of the bigger semiconductor companies aren't doing anything, talking about like names like, talking about the biggest ones, right? Like the $1 trillion companies or companies at the $400 or $500 billion range. TSM is like 1.55 trillion, right? So like keep that in mind. They're such a strong company recently. One of my outperformers by far. Now that being said, here at about 370, you got to add 10% to this valuation. So your valuation right now is on the verge of, it's about 28 something forward PE. The PEG ratio is also going to be about a 1.5. Forward price to sales will be around a 10 right now. So it's no longer, you can't say it's cheap anymore. You can say it's fair, but you can't really say it's cheap. And also the technicals are a little bit extended. So you'd be buying on, you're not buying the cheapest valuation for TSM right now. You're also not buying a good technical pullback level either, but I'm holding all my TSM shares. I have no reason to sell right now whatsoever. It's just, would I be adding up here? No. Can I blame other people for adding? And we talked about this in the 330 area. No. If you're building a position, if you want, these are like long-term holds for me, right? I'm not swing trading them on a short-term basis. Very solid long-term holds. TSM is arguably a unicorn company as well, right? They have the lion's market share of what they do. They have the largest competitive advantages in their space. The only risk is the whole China-Taiwan situation, but that's been a risk ever since I've been investing in TSM for the last 6 years or so. So keep that in mind. So that's everything we had for the overall tech landscape rundown and earnings rundown and things of that nature. Next week will be a bit lighter on earnings, so the videos will be shorter, but you guys know during earnings season, the videos are quite long because we've got a lot of things to cover, earnings. And if the markets weren't doing anything, then obviously I could spend less time on a lot of these charts or whatnot. But there's a lot of let's just say divided opinions and divided emotions in the market right now, with good reason, right? Because a lot of these names are just getting destroyed. That being said, that's everything for the big tech list. Now let's spend about 5-10 minutes talking about the biggest gainers and losers of the day. All right, so talking about some of the biggest losers of the day. So A-Lab had a big decline here after their earnings, even though they did post pretty decent results, guys. The guidance, disappointing Wall Street a little bit. However, very solid company. This one, we talk about all of them, right? Like all these second order data center plays, everything within the data centers, the connectivity plays and things of that nature. A-Lab is sitting at a very nice support level right now, 140. You can also say the same thing about companies like Credo, also 12-month EMA into support. You can say the same thing about Celestica as well. Great companies, right? Arguably the one that has the most compelling valuation out of all of those that I just named is Celestica. So please keep that in mind. But these data center connectivity plays are very interesting. And we get to hear from ANET tomorrow as well. Their backtest to the 12 EMAs were very solid, right? So whether it's Vertiv, whether it's ANET, a lot of these things that go inside the data center, whether it's fiber optic cables, cooling solutions, thermal solutions, everything, right? Just very, very, very solid players overall in terms of that niche. Moving on to a company like Lyft. Lyft, they had their earnings, guys. Their earnings were okay, right? They missed on revenue by a lot, which is why I say okay. Keep in mind, right, my favorite player out of all of this cohort, whether it's DoorDash, Lyft, or Uber, is probably Uber by far. So I'm not playing Lyft, but the valuation down here is a little bit compelling. You're talking about a company that trades for $5.6 billion in terms of value. And just price to sales for this business, right? It's not as if they're not growing. They are growing. If you take a look at price to sales, their sales are 7.3. They're trading under a 1 forward price to sales, right? It's just that they don't have the same margin profile as some of the bigger players, such as Uber and things like that, right? So that's why I don't play Lyft specifically, but I can't blame anybody that does. It's just that, my favorite one, of course, is Uber. Take a look down here across the list. You'll see more software names. UiPath, which is one of my small cap plays that I've been building a position in, just getting hit by software. It seems as though the market has just completely forgotten about all earnings reports, right? Where you look at Path, that had all these companies that last earnings, they had huge earnings reports for various reasons, like Path or like Rubrik that went up like 20% after earnings. They just gave everything back. So there's nothing wrong with the businesses. It's just they're being lumped up in the software trade. So UiPath still one of the small cap plays that I'm very interested in continuing to build a position because I'm holding it for the next few years, right? Zeta is also something similar. Zeta is another small cap play that I've been building into. Had a nice little rally right here. They have earnings coming up the 24th of February, so that should be very interesting to pay attention to as well. Coming to support, Zeta is one that I've been building too, but I have to fully recognize they're just not in favor right now. They're just getting dragged down with the overall market. Doesn't matter what their earnings say, doesn't matter anything. It's just the sentiment, right? And you can kind of thank some of the bigger players there for dragging all these down. Salesforce just continues to get absolutely destroyed. You know, some of these valuations are coming down in a substantial fashion, right? ServiceNow, arguably, if I had to buy Salesforce or ServiceNow, I'd probably buy ServiceNow. ServiceNow, we did the valuation at 117. It wasn't even that cheap to begin with, right? It just goes to show how expensive ServiceNow was at a certain point in time. So keep that in mind. Like companies like Adobe, like look at Adobe's valuation, man. I just did it today for you guys. Adobe's valuation at 260 right now is a 11 forward PE and a 0.91 PEG with a 9% free cash flow yield. So, I mean, some of these companies are like good attempts for large cap. I'm not playing large cap SaaS just because if I'm playing SaaS, the recovery of SaaS, I'd rather go with smaller players because I feel that they can lift faster in terms of like share price appreciation, just playing the recovery of the overall narrative, which is why I've been building not very large positions by any metric, but positions in Path, positions in Zeta, right? They're smaller players. It's much easier to lift a $3, $4, $5 billion market cap than it is to lift or relift a $100 billion market cap, something like an Adobe, right? So we commented on the risks to SaaS so many times in the past few weeks. I'm not going to go over them again. You guys probably all know them by now. The risk moving forward with these companies, guys, is that the narrative just doesn't go away. Like it may go away temporarily, and you may have a nice bounce or bounces and a progressive slight recovery. You know what the problem is, though? The problem is that like every single month or two or every single quarter, again, you're gonna have to deal with Gemini's new update does this, Claude's new update does this. It's just like not gonna stop. You know what I mean? For a lot of these large enterprise resource companies with tons of employees and things of that nature, right? They're very somewhat somewhat bloated companies, right? They're not like a Palantir, which has a very limited amount of employees for the amount of deals and the amount of revenue that they're going to be able to generate, right? These companies have a lot of employees and things of that nature. I'm not saying they're not good deals for a bit of a recovery trade. You can choose to play them individually, or you can choose to play the overall recovery of IGV, just the software, a tech software ETF. The biggest holdings in this are Microsoft and Palantir. So please keep that in mind. So I'm playing some of the larger ones, but I'm also playing IGV. I'm not playing Adobe. I'm not playing Salesforce. I'm not playing ServiceNow. But I don't blame you guys if you guys are playing those specifically. There is a bit of a mean reversion trade to be had here. It's just that it's not fully there yet. Moving on to other little niches of the market. I mean, we talked about the other ones like Robinhood after earnings, so I'm not going to bring them again. But TE Energy is one of my favorite plays, vertically integrated American solar, everything from the panels to the actual silicon that makes the model to make the panels. Coming down here, guys, 6 to 5 is the reload area, in my opinion, for TE Energy. A lot of possible growth on the table for this one remains. Some of the battery energy storage plays like FLNC finally giving a nice re-entry zone down here, 16 to 15. Talk about EOSC as well. That could be a very popular name coming in to the near-term future. Anything under $10 down to 8. If we're looking at kind of buy and hold these for the next, arguably 2 to 5 years as this thesis expands and as the power requirements for these data centers become more and more prevalent, definitely something to pay attention to as well. Reddit, we touched upon just the other day. They had great earnings, but still the stock is being sold off anyways. It all started with the Australian ban on social media for youth under a certain age. France, came in with the same concept. Reddit down here at 140, guys, is objectively a decent bid, right? It's a very decent bid, strong business, strong margins in the future, strong advertising growth, everything considered. That being said, the next area of support is 125 to 120. Another company that's pretty cheap right now that it's worth a possible attempt in, right? Some of the defense contractors that were very popular, such as military drone purposes earlier on in the year, such as AVAV. AVAV, nice little pickup down here, lower 200s. Not saying that it can't drop lower, but these are all companies, guys, that had a great start to the year in 2026. And then gave back all their gains. KTOS as well has kind of given back all of its gains too. KTOS, I might be a little bit more interested if it comes back down 75 to 70. These are all just smaller cap defense players that could be interesting to hold for the next 2, 3, 4, 5 years as we move more and more into drone technology and various things of that nature. I mean, you could reference companies like Ondas as well. I've been very clear in saying that Ondas for me, 8 to 6 is probably the area that I'd be willing to build a position in if I were interested in that. or names like OSS, Edge Compute, things of that nature, which are very popular early on this year that have given back some gains. Names like Rocket Lab as well, which I have to shout out. Rocket Lab's going to be very, very interesting. You might even find me building a position here if you do drop in the $60 to $50 range once more, as we're kind of giving back some of the early gains from the start of the year so far. But these are all names, guys. When I'm talking about buying these names, I'm not talking about buying them and looking for instant gratification gains. I'm talking about names to build a position in for key themes that I think will be largely in play for the next few years, not just the next few weeks, months, and quarters. Sure, it's nice to buy something and seeing it go instantly up 40, 50, 60, 70%. I'm just throwing out ideas for you guys to kind of look into the next, in the next few weeks during these consolidation phases for names that you may want to look into for longer term holds, because they're addressing certain key themes that will only get bigger over the next 3 to 5 years. And the time to really explore them is, in the shorter term rather than, waiting too long for them, right? Affirm, another solid pick. We covered them after earnings. I really enjoy this stock in the mid 50s to build a position in as well. They're the best buy now player in the game right now, and I don't even think it's close at this point in time. Company like Intuit, one could argue that it's being disrupted, but I'll wait until Intuit's earnings, February 26th, to make a determination whether or not I want to pick this one up. But at $400 right now, guys, it's so cheap, man. 17 forward P, a 1.17 peg, and a 5% free cash flow yield. Numbers on Intuit that you haven't been able to see in years and years and years, but it's software at the end of the day, man. And software has just been wildly out of favor. Some Neo cloud providers, Nebius has earnings tomorrow. I'll cover them on the channel for you guys. If ever we revisit this $75 to $60 range, again, I'll be picking up some Nebius. You guys know my thoughts on that. And I think that's it, man, for the biggest losers of the day. Talking about the biggest winners of the day, we already briefly touched upon them. We touched upon Vertiv. We talked about SanDisk and Micron, how they could be buys even at these extended technical levels just because of the fundamental story here that's at play for the demand, and the fact that their fundamentals, so to speak, are still quite cheap, right? Talking about like very low teens, or sometimes single digit price to earnings ratios, right? With improving margins and pricing power, and just, a very big cycle ahead of them. So please keep that in mind. Just a lot of semiconductors, guys, are very well positioned out there. I don't think there's much else to talk about. If anything, we talked about most of this stuff when we kind of went into either the indexes or otherwise, or we did cover them with earnings recently. Spotify, I just did them the other day. If you guys didn't see those, definitely check them out. Names like Walmart continue to trade extremely rich, but it's part of that whole consumer staples rotation trade, right? Walmart's been doing good. Costco has been doing pretty good as well. Booking.com, haven't talked about it. We will probably cover them when they have their earnings. Booking.com for me is indeed a buy at these levels, even if we come down a bit lower, the 200 weekly EMA under 4,000. Solid, man. Booking.com is not going anywhere despite what the chart may lead you to believe. So just some of these ideas will stay front and center for me. Some of the very solid names, very strong business models, strong moats, a history of share buybacks and just dominating their respective landscapes, their respective niche. I'm very, very big fan of. So we'll try to cover more of these names tomorrow, but that's going to be it for today, guys. So hopefully you enjoyed. If you did, consider dropping a like on the video. Would appreciate it for the growth of the channel. Consider subscribing if you're new. Would love to have you back. And last but not least, if you have any questions, please feel free to leave them down below in the comment section, and I'll get to them as soon as I possibly can. Thank you very much as well for being patient with my video uploads, guys. Give you guys an idea of my schedule, right? While I'm in Asia, I wake up at like 8:39 for the most part. Then it takes me like a good hour and a half to build these videos and just the themes, ideas that I want to cover, go through the earnings reports, listen to the earnings calls, derive the numbers, all that stuff, right? It takes me like a, good like hour and a half, sometimes 2 hours to do very early morning when I'm drinking my coffee. Then I got to film them. Then I take like an hour and a half. And then for some reason, when I'm not at home, the YouTube processing times for the uploads are fast. That's just uploading the video to the YouTube network, right? It takes like 3-4 minutes. What takes time is that YouTube holds them back for processing the different qualities and doing some background checks and stuff like that. And it takes them like an hour. So that's why the videos come out so late. I wish there was a way for me to cut back on that processing time, but I get it. I know the videos are late. I mean, the only thing I could possibly do to solve it is just wake up like 2 hours earlier, like 7 in the morning on vacation. So maybe I'll have to do that, but if not, I appreciate it, guys. And at any point, it's not as if we day trade on the channel. So all the information that I give, even if you watch it the next day, should get a good impression. The stock prices won't change much. The themes and narratives won't change much either. And the earnings presentations are what they they are, right? So thanks very much for watching, guys. Appreciate you guys as always. Appreciate all the love and support that you guys always give me in the comment section. Really appreciate that. And just take care. Have a good day in the markets tomorrow on Thursday, and I'll see you guys tomorrow for another Thursday market recap. Peace.